I've shared, there is also inventory in the US that we see and also our peers see. So as the operators continue their deployment and scale up their deployment, as the inventory gets reduced, then we shall continue to see fresh demand growth from North America in particular.
Okay, got it, sir. So my second question, could you please share the volume growth for OF and OFCs for the quarter and full year? And also, could you please share on the optical interconnect
Volume
attach
growth.
rate, uh,
Yeah.
value terms?
No, so just to be transparent, we are not sharing actual capacity and volumes for last couple of quarters for competitive reasons. What we can share is that the volumes have increased in quarter four versus quarter three. And certainly going forward, we have positive, as I shared, the shift from 33 million to 42 million will be completed by H1. So I think that's a good capacity that will be coming on stream. On the fiber side, we continue to look at options to scale up our fiber both in India as well as our fiber draw operations in China. So I think that's also something that will be positive. So I think we will have good amount of capacity available, and as we continue to secure our contracts in our focus markets, we should start seeing volume increase, particularly in second half of this year.
Thank you, sir. So my another last question is, could you please share the capacity utilization on across plants in India, China, and US? This is my last question.
Sorry, I won't be able to share that. As I just shared, we are not sharing our capacities and utilizations at a unit level. Suffice to say that we had good utilization in Q4. We are watching the market closely in quarter one and quarter two, but certainly confident of our capacities coming on stream, and we are working hard to fulfill those capacities.
Thank you, sir. That's it from my side.
Thanks, Bala. We'll take the next question from the line of Mr. Hiten Boricha. Hiten, you can ask your question now.
Hello.
Yes, we can hear you. Please go ahead.
Yeah. Okay. Yeah. So my first question is on the inventory build-up which happened in US. So can you shed some light what exactly happened and why this inventory we saw inventory build-up in US?
Yeah. So I think overall, what we had seen in the last 12 to 16 months is that the lead times had increased quite significantly, going up to almost 40 to 50 weeks in the US for certain cables and connectivity. At the same time, various telecom operators, service providers in the US had some very strong and ambitious plans to deploy the fiber, which still continues, by the way. So in this period, because of the large lead times and their clear visibility of deployment, they had started building a lot of inventory. What we now see is that they are probably not being able to execute on the ground, mainly because of labor shortages, trained labor shortages, and some permitting issues. So because of this imbalance, they have a certain amount of inventory built up, and the other side they are not able to deploy. Also, what we have seen is now the lead times have come down from about 40, 50 weeks to probably anywhere between 6 to 10 weeks. So the operators are also now aware that as and when they need it, they can get the cables quickly. So that's where we are in this in-between phase. The intent to deploy continues across the operators. Most of them are listed and they announce their capex plans. So we are tracking that very closely, and our own conversations with them, they continue to remain committed, but they are sharing this visibility of the inventory. Our current visibility is that it will improve in H2, but of course, we're working on how to further improve our sales in H1 as well.
Okay. So this is the main reason for a price. So just want to understand how is the pricing volatility for the cable because of this inventory buildup?
Sure. Yeah. So I said as at two levels. One is in certain markets, like in China, Southeast Asia, pockets of Africa, where we do see some of the Chinese players. There we have seen some reduction in pricing because of say demand reduction in China, which we believe is a temporary phenomena, probably for next few months. So that is on one level. I think we have seen limited competition or almost zero competition of Chinese in Europe and North America. So pricing is still stable. It might have come down a little bit given these inventory levels. So our bigger focus is to continue our commitments with our long-term customers. And the way the contracts are set up generally is that there is a good understanding both of volume and pricing. But given the long-term nature of these contracts, we continue to negotiate with them and ensuring that the volumes also continue. The other element, Hiten, is very important is that our factory in US is also coming up. So there's a good amount of effort we're putting in to ensure that we get good long-term contracts to support those facilities to be fully utilized.
So can you quantify the pricing? What was it in FY22 and in FY23?
No, I think it'll really vary by market. I think, for example, we would have seen probably a 10 to 15% reduction in China on the fiber prices, but it would be smaller in other markets. And again, I wouldn't generalize, but each operator and depending on which market they are, who the competition is, I think that varies. Anywhere between 5 to 10% is possible in other markets as well. And that's again just a general data point. Each customer and depends on our contract and our negotiations that would vary.
Okay, okay. So only one last question, and then I'll again get back in the queue. So just question is on the dividend. We are giving the dividend of 1 rupees, and the other side we are also looking to raise a fund. So yeah, I know the dividend outflow is very low when we compare to the fund rate, but just wanted to understand the rationale behind that, why we are giving dividend and other side we are looking for fundraise as well. Thank you.
Yeah. So, Hiten, as I said, that dividend is important because it's a source of earning for a lot of investors for us. So, keeping that in mind, and as per the policy, we are supposed to declare the dividend. So that's the reason that we have declared the dividend. Yes, we will be raising the right issue, but right issue will be contingent on the right timing and the right market conditions. So, we'll be watchful of that to get into the market with respect to the right issue.
Okay, okay. I'll get back in the queue, sir. Thank you.
Thank you. Thank you, Hiten.
Thanks, Hiten. We'll take the next question from the line of Mr. Prateek Singhania. Prateek, you can ask your question now.
Yeah, hi Ankit. Hi Tushar.
Hi.
Ankit, in terms of the deployment rate, how do you track it? Like, what metrics do you observe, whether it is monthly, quarterly, fortnightly, to determine whether the ground level demand of fiber optics in US is not slowing down?
Sure. Yeah, good question, Prateek. It's also my brother's name, so I'll give you a good answer. So I think 3, 4 metrics. As I said, a lot of these customers of ours are public, both in Europe, US, Australia. So they regularly publish both their capex spend, their forecast for capex at least for next 12 months. And then on a quarterly basis, they share both in terms of subscribers as well as homes passed. So there's clear, and they give a target of home pass generally, at least for 1 year forward. And some of them even have 3 to 5 year targets. So that's something that is from their own data that gets published. On top of that, we see very interesting data points from deployment companies. So you can give you some examples. There are companies in US called Dicom and Mastec, which are listed. And then they share their data points of how they are deploying the fiber on behalf of these customers. And again, you can see the latest Dicom results. They've just signed multi-year contracts with many of our customers on where we supply cable and they would do the deployment. So these are kind of 2 or 3 data points. Of course, then we have CRU data, which we also share with you from time to time, which is probably a third data point. Of course, the most important being our own conversations with the customers, how they are seeing the visibility. And of course, on very regular basis, that conversation happens at senior levels. So I think multiple data points, and hence the outlook we are giving you is a summation of these data points.
So for the calendar year 2023 H1, we are witnessing slowdown in deployment rate as well as the inventory level coming down at the customer level, or how it is? Like, do you have any growth rate in terms of deployment, whether it is down sequentially or up in terms of percentage?
So happy to share probably some data points with you offline purely based on what some of our customers have shared.
Hmm.
But I think what definitely we can tell you is that there is the biggest constraint in North America, in Europe, various parts of the world, is even if operators want to scale up, say 10-20% year on year, they are
Hmm.
getting constrained by availability of manpower. This is a global concern where operators are now investing directly in building in the training capability of people. And so this is something that is now becoming the major constraint to rapidly scale up the deployment. So we don't see a constraint in capital. We don't see a constraint in intent. In fact, most of them have talked about how they want to grow their deployment, but they're clearly seeing a challenge in execution on the ground. And then in some pockets of US, some pockets of Europe, there's also constraints in terms of permission and permitting, which also again is an ongoing effort to ease those out, like we see in India as well.
Okay, got it. And in the digital business, you talked about having an order book of almost 650 crores. So this amount would be executable over how many years? And in next, say, 2 to 3 years time, how scale this business can reach?
Yeah, Raman, over to you.
Yeah, the orders are both near term and long term. So we have some orders that stretch to 3 to 4 years duration, and then there are many orders that has to be executed over the next 18 to 24 months. So from that perspective, and most of the orders that we have got is in the third and the fourth quarter. So we see the future pretty good in terms of how we are going to execute those orders, and we continue to gain new orders in this quarter as well. So it's pretty good the way we see it.
In next 3 years, what kind of a scales you aspire to reach in this business in terms
See
of top
this
line?
particular year, yeah, this particular year, if you look at our guidance that we have given, we will at least grow the business by at least 3 to 4 times. That's what we're expecting for this year.
Hmm.
And I would say that for FY25 or FY26, again, futuristic, too much. It is too much in the future. But still, looking at the way that we are scaling from a quarter to quarter perspective, it looks pretty good. It will have decent growth in FY25 or
Yeah,
FY24. So I already mentioned, yeah.
sorry, Pratik, I think
Sorry.
bit early to
Yeah.
give a longer term forecast. I think from an STL perspective, definitely one focus, as for everything in STL, is first focus on profitability. So we have put in about 120 crores last year into this business as an investment. Also, probably similar level will go into this year. And the real priority now for Raman, while tremendous work on the order booking and right team, now to break even and start becoming profitable, towards the end of this year is what he has committed. So I think that is more where we are really focused. I think clearly a lot of success with very high quality clients. So we're watching this on say quarterly basis, and certainly there's good potential to grow it.
Okay. And in terms of the demerger, the right issue or the fundraise that you plan to do, would it be like any like segregation is there wherein how much you will put in the services plus digital business versus how much you'll be using for the product business?
No, at this point in time, this entire demerger is going to
Hmm.
take anything between, I would say, 9 to 12 months, depending on the NCLT approval process. So whatever the proceeds that we may get will be used for the both the business in order to bring down the overall debt. So whatever we discussed in terms of debt to EBITDA 2.5 times is not considering any kind of right issue proceeds that we may have.
Got it. And in terms of optical interconnect, I assume that a lot of our products are under the trial phase, testing phase with the clients.
Yes.
So, any like visible breakthrough that you anticipate in FY24 for your optical interconnect business to grow maybe 2x or something like that? Because it's a very good business per se. So anything with respect to Australia and US market where you anticipate a good growth in optical interconnect can come from this geography?
Yeah, I mean, look, I think good question. As I said, it's a balance of all three. There's still work to be done to build product portfolio, both for telecom operators and I think also eventually for data centers. I think that those are areas we clearly need to build that out. We continue to build our internal teams also who have specialist knowledge technically and sales wise in this field. So that's another work in progress. The third part is on the IP part. As I said earlier, also this is a field with a lot of IP, and we want to make sure that we build the right product with the right IP as we're entering these global geographies. And then obviously the part that is probably taking longer than we expected is the customer approval cycle. And I think that's probably something where there's been learnings for us, and we'll really look to fast track that as much as possible going forward. And that's both at the customer level and at the installer level. So I think these are some of the let's say learnings, but I continue to be positive. There's no question. I think as you said, it's a good business to be in. It's complementary to our cables. The customers are looking for solutions of cable and connectivity together. And really, even if you look at, for example, our latest product, the 180 micron, essentially with a thinner fiber, you can get a thinner cable. Those thinner cables can be more compact and lead to a more compact interconnect solution, right? So it's all interconnected for us. And the more of these solutions we can provide to our customers, there's greater value for them and for us.
Right. So that leads to my other question, another question, that can we expect at least the fiber division of STL to be running at 90% capacity utilization for the current year? Because see, you have such a good product in terms of your capability, and everything is all top notch. So at least whatever we need internally, we can consume in the balance. Is it possible to increase that like external sales of fiber in this current year? Say
Yeah,
what?
so I think it's look, as I said, the strategically we've always said we want to focus our fiber towards our cable and interconnect will be our go-to market. So that continues to be our strategic focus going forward. And there, as I said, we want to be tied up with tier one customers globally to make sure that they buy our cables and interconnect solutions. So that remains our priority. And I think then it really is a function of how quickly can we scale up as these capacities are coming on stream that I spoke of in the US and other places. How quickly can we utilize those capacities? And then obviously then pull in the fiber for making that happen. Very, very positive about our capacities coming on stream by end of H1. I think we have to watch the market very closely, particularly in US, to make sure that we can pull through those volumes, and then on the back of that, the fiber.
Right, because at present we have 50 million FKM fiber capacity,
Yes.
and it will be a 42 million FKM cabling capacity.
Yep.
So the balance, at least the balance, whatever is 8 million, at least 90% of that can't we do like the external sales till the time we set up another cabling capacity, maybe in US or domestic?
No, I think, see, that those options will continue to remain, and we will be doing some amount of fiber sales very strategically to some long-term customers, and also value-added fiber, so next generation fiber, etc. So those are things that will continue, but also to be mindful between cable and fiber, there's typically a 5% scrap. So it won't be that the delta is exactly what we will sell externally. Some portion of that we would be utilized. We would use larger portion than 42 in our own internal captive requirement.
Okay. And my last question would be respect to the services receivable. Can you update anything with respect to that? What's the current status?
Sorry,
The receivable for services.
so I think receivable for the services, with respect to some of the projects, as we continue to execute some of the projects, it starts to liquidate the outstanding that we have on GSO business.
Okay. So what kind of operating cash flow can we expect from the services business this year, given the release in working capital from there?
So we are targeting something like 100 to 200 crores to be released from the service business this year.
Okay. Great. Thank you so much for answering my questions, and all the best.
Thank you.
Thank you.
Thanks, Pratik. We'll take the question from the next question from the line of Mr. Sunny Gosar. Sunny, you can ask your question now.
Yeah, thanks for taking my question, and congratulations on a improved set of numbers and also some debt reduction after quite a few quarters.
Thank
Uh,
you.
my first question is in terms of the growth rate that you have highlighted at 10 to 12%. Can you basically help us understand what would be the growth in the service business in that, and what could be the mix of growth from the optical business? Because that growth rate seems to be very conservative, considering your digital business will grow significantly, although the base is very small, but
Yeah.
there is very high growth there. So are you
So,
assuming a flattish or a degrowth in the service business?
yeah, so look, I think so maybe I'll break it up. So certainly optical, we have capacities coming on stream on one side. Other side, there are some, I would say, near-term, areas we need to look at in North America in particular. We also need to be mindful and watch closely on the pricing and lead time. So I think those are a combination of things we're watching out for, particularly H1, but certainly quite positive or more positive in H2 on the optical. At the same time, as we also shared briefly, there's a lot of focus now internally to improve our cost structures and reduce our working capital, which should support the business as well. So that's broadly what we're trying to do on the optical part. And of course, then continue to look at options to grow our interconnect business as well. So that's on the optical. On the services part, I think three, four large opportunities for us. We are looking at scaling up our deployment with operators like Airtel and Jio. So some interesting opportunities there. There's some couple of opportunities we've started to get into on the managed services, and so we're looking to scale up out there. And then, of course, there could be a big bang at some point in the current year if BharatNet materializes in some form. And certainly that's an area, again, with the right payment terms, right milestones, and cash visibility, we would look to participate and be a leading provider both on cable connectivity and the services for that business. And then I think, as Raman alluded to, we've started with a base about 70 crores. We think it's a good base to now scale up from there. But again, it's a small number compared to the overall STL number for the current year. Current year, we're at about 6,800, 900 crores. And so even if you take 10% growth of that, that's another, say, 700, 800 crores growth on that. So I think that's where, I would say that balance is there. Some growth will happen on optical clearly. Services, we do see the opportunities, but we are very, very mindful of cash being a priority in the services business versus top line growth. And hence, probably we are conservative there on the scaling up of services. And as I said, IT services are small base today.
Sure. But just to reconfirm on this, in your guidance of 10 to 12%, you are not assuming any big or basically largely flattish numbers in the service business, right?
Sure. Yes.
Okay, got it. In terms of
Sunny, coming back to your specific point, the purpose of creating two separate entities that the capital should not become constraint for the growth of these two businesses. That is the fundamental way that we have been looking at, so that both the business can grow independently without having any constraint on the capital. So that's a fundamental. That's the reason that we are creating this company. This is one of the clear reasons that we are looking at, so that both the companies can grow independently.
Sure, got it. My second question is on the demand outlook that you highlighted. Basically, you've been highlighting that there is some kind of demand softness in North America. So, considering the situation, do you foresee any volume declines on a QoQ basis? Or what you're trying to communicate is on whatever base we have in Q4, there may not be a significant growth at least for next 1 or 2 quarters, and then we can see growth in the second half, or you see some declines for the next 1 or 2 quarters?
So we're still, I won't be able to comment in quarter 2 because I said it is quarter 2 for us would be end of H1 in calendar year for the US. So we're watching the data still closely. But I would say that quarter 1 there is possibility of quarter on quarter volume decline. Also have to be mindful that both Europe and US are typically better margin regions. So I think those are elements that we are watching closely in terms of not just volume impact, but also our profitability impact. As I said, we've got these inputs from the customers. We're actively looking at how do we look at alternate customers? What more can we do? Can we get more wallet share from our current customers? And of course, we're also looking at other markets outside of North America and Europe, including in India and other markets where we can further scale up our cable sales.
Got it. Got it. Fair enough. My third question is on the margin profile. So you've done a very good job of scaling the optical margins to
Yeah.
about 21%, more than 21% in Q4. Basically, on the cost, you've given a good direction on the pricing and
Yeah.
demand, but on the cost side, are all the cost savings in the base, or are there further potential cost savings possible from, say, either helium cost or any other raw material or logistics cost? So how should we look at the margins for FY24 as a whole? I understand Q1, Q2 may be slightly challenging, but how should
Yeah.
we look at FY24 as a whole?
Yeah, so I think still, as I said, a little bit early to say. I can tell you what we are focusing on. I do believe there are opportunities for cost reduction purely from the operations. Then, of course, as we had called out, helium has been one big X factor for us. And that we still continue to see challenges and shortages in the market from a pricing and availability perspective. Our own current view is that probably another 5 to 6 months at least, that will continue to be a concern. On the positive side, obviously, we have talked about, trying to push forward on the connectivity side where we have seen higher margins. So I think that is something that certainly into H2, we do believe that should improve. And there's a focus there. So I think it's a balance of these two, three things, some possible volume decline, some challenges in margins because of US sales, some cost areas where we are focusing to improve, but helium continues to be a concern, and then possible upside from the interconnect. So I think it's a balance of all of these things. I would say currently we are focused that at least we should get to 20% margins, but again, it can vary a little bit, at least in H1.
Okay, got it, got it. And my last question is on the service, the margin profile in the service and the digital business. So there was some margin improvement that we saw in the service business in Q4. And now with UK business, say, breaking even in March 23, how should we look at the margin profile in the service business going forward? Say for the coming immediate quarters and the full year FY24.
So, Sandeep, we have been looking at the margin profile, EBITDA margin profile to improve presently from 4% to on a consolidated service level to the 8% kind of a level that we've been looking at. So gradually moving on quarter basis with improvement in terms of overall operations in UK, we see that there will be a gradual growth in terms of an EBITDA.
So will it be fair to assume that 4% is the base now, and you should see gradual improvements every quarter going forward?
Ideally, yes.
Okay. And my last question on the digital business. So the EBITDA burn was about 35 crores in this quarter.
One part mindful of that, especially monsoon is typically lower deployment, right, in India. So I think that's something we'll have to watch for in this kind of June, July, August monsoon period, where actual deployment would be a challenge for our projects across India.
Sure. Got it. Got it. And on the digital business, your burn in Q4 was about 35 crores. So is this the peak quarterly burn that we should see, or there could be for the next 1 or 2 quarters higher EBITDA loss and then basically break even towards the end of the year? So how should we look at that?
Yeah, we believe this is the peak. It should start coming down as our utilization of our teams and the projects that we have start to improve. And then, as we said, get to break even by, say, between Q3, Q4 time period.
Right. But that you in one of the statements you highlighted that your investment in this business for FY24 also could be 125 crores.
Yeah.
But
Yeah,
then
fair
that
enough.
won't add up, right?
Correct, correct. So between, I would say, currently visibility is around 120 crores. Obviously, say for example, if entire Q4 breaks even, then to that extent, 20-30 crores could be lower. So, but we are
Okay,
in that range of, I mean, I would say safely take about 100 crores, for example.
got it. Thanks for the detailed answer.
Yeah.
Thanks, Sunny. So, ladies and gentlemen, with this, we come to the end of Q&A session. And now I now hand it over back to Ankit Agarwal for closing remarks.
Um, Before I do my closing remarks, I just wanted to highlight that I was recently in a forum in Brussels with our ministers and representing on a panel with Indian CEOs. And I must say there was a lot of excitement and positivity for increasing partnership between Europe and India. And really, I think that presents a lot of opportunities even for STL across our businesses on optical and services, and of course on IT services as well. So I think there's a very, very strong interest. I think it was a privilege and very grateful to be part of that forum with the ministers, and I'm very bullish that the business between India and Europe will grow significantly from here, given the kind of conversations happening. So overall, again, thank you everyone for attending this call, showing interest in our company, for all your inputs over the several quarters. We hope we are able to address and clarify all your queries. We hope we've given you good visibility of how we see the market in the coming quarters. For any further questions and discussions, feel free to contact Investor Relations team, which includes myself and Tushar. We really look forward to continuing this conversation with you in the future. We welcome you to visit our facilities, which I think you'll find very interesting. And do keep in touch. Thank you. Stay safe.
Thank you all.
Thank you.
Thank
Thank
you.
you. Thank you, Raman.
Jay, you can stop the recording, please.
Recording stopped.
Do we log off?
Yeah.
Okay. Thank you.